Wealth tax, a modern Robin Hood, or a financial Thanos?
Fine. I'll do it myself.
Let's find out in today's episode of the Financial Podcast. My name is Lucas.
And I'm Marcus. Please, my fellow investors, remember to invest in the subscribe button and deposit a like on the video.
Let's start with a definition, shall we? A wealth tax is a tax levied on the net fair market value of a taxpayer's assets. Wealth being defined as assets minus liabilities. This means that a wealth tax applies to the net fair market value of all or some of a variety of asset types held by a taxpayer, including cash, bank deposits, shares, fixed assets, personal cars, pension plans, money funds, owner-occupied housing, and trusts.
So quite a lot.
Quite a lot. Recently, politicians in, for example, the United States have proposed adding a wealth tax as a way to distribute the tax burden more fairly in a society with immense economic disparity.
What the fuck?
A wealth tax in general hasn't been very popular until around 2017, and now it's becoming increasingly more popular, especially due to COVID.
Yeah, and also Argentina, for instance, introduced a wealth tax due to the COVID situation, actually. So there are a few different ways that wealth taxes are usually levied. They can either be domestic or global. And what this means is that domestic wealth taxes is only levied of ownership in domestic assets. For instance, domestic stocks or domestic real estates, private equity or something like that, things that are in your country, while global wealth tax is levied on the total net assets of an individual. So this means that everything that they own, even if they have real estate or shares or something in another country, for instance, I myself have shares in the US or in American companies, so I would have to pay wealth tax on these assets even though they are not in my country. So they would be included in this wealth tax. And furthermore, there's also caps. So most countries have some sort of cap before you even have to pay this wealth tax, as it's usually used to tax wealthier individuals and not so much people without any assets. So for instance, in Norway, you have to have net assets of over 150,000 euros. I don't remember the exact amount in Norwegian crowns, but at least 150,000 euros before the wealth tax even applies to you. And after that, you only pay wealth tax on the money that exceeds 150,000 euros. So if you have 160,000 euros in total assets, you would actually only pay the wealth tax on the 10,000 that exceeds the 150k.
So when it comes to what rate you pay on wealth tax, it differs between different countries. Some have a progressive tax rate, meaning the more you earn, the more you pay, similar to how the normal tax rate works on
income,
the money you earn when you work in Finland. And then others have a fixed rate on the wealth tax. For instance, in Spain, the tax rate is progressive and is between 0.2 to 3.75%. above 700,000 euros. So again, Spain has a progressive rate and Norway has a fixed rate of 0.85% on everything after 150k. Let's move on to the deductions. Let me ask you this, Marcus, can you explain deductions for us simply?
Yeah, I think I can explain it quite simply. It's basically that you can take away all the money you have spent in order to receive any sort of income and remove it from the taxable amount. So basically you can lower your full taxable amount through these deductions. And there's a few ways you can do this, but usually it's if you, for instance, spend money to earn money, you can actually deduct the money you've spent.
I think that was a very good way to explain it. When it comes to wealth tax deductions, there are usually a fair bit of these deductions that you can use when you are being taxed on your wealth. Like we mentioned earlier, loans and mortgages decrease your net worth. So if you still have a loan on your house, chances are you don't have to pay wealth tax, in Norway at least. Another example from Norway is primary residence. Primary residence is when you can prove that you are living in a particular house and you use it as a primary residence.
What's up, y'all? Big Snoop D-O-double-G. I want to welcome y'all to my house, the dog house. Slide in.
On this real estate, you actually only pay 25% on the market value of the house in wealth tax. This means that if you had a house worth 1 million in Norway, but a loan for it for 500,000, you own the house for 500,000 because you take the total worth of the house minus the loan. Normally, you would have to pay wealth tax on the 350,000 that exceeds 150k, because 500 minus 350 is 150. But now, instead, if you can prove that you use this house as a primary residence, then the 500k for your house is actually only 25%, i.e. 125k, meaning that you pay no wealth tax at all.
It's free real estate.
Since it doesn't exceed the 150,000 threshold. So deductions can be super effective in lowering your wealth tax, and if you live in a country with wealth tax like Norway or Switzerland, you should examine what deductions there are.
Okay, so we can move on then to some arguments for and against wealth taxes, as it's a pretty recent topic that is up in the air right now, and a lot of people are debating whether it's a good or a bad idea to use it. So the purpose of a wealth tax is supposed to tax capital in the same way as income is taxed, or at least balance the two a little bit. As usually income, like a salary for instance, is taxed much more severely than capital income, such as capital appreciation, land appreciation, or private business appreciation. Usually, like in Finland, it is difficult to tax appreciation, as capital income is only taxed when you sell. So if you never sell, you are not taxed. In Norway, however, even though your dividend stock goes up and you don't sell, you will still be taxed, as you will have to pay more in wealth tax for your sick unrealized gains plus the tax on the dividends. When you receive dividends, for instance, tax-wise gimme, the state, goes double dipping in your profits.
Stupid fat hobbit.
Arguments for wealth tax include that it's a way to actually effectively tax the rich, as it can be taxed on global assets, meaning tax havens become problematic, legally at least. Of course you can do it illegally, but that's a whole nother issue. And appreciation is also taken into account, like we just discussed, meaning that wealthy investors can't just hold their Amazon shares and watch them grow in value with no tax effect as long as they don't sell. It makes it so that even individuals like Jeff Bezos or Warren Buffett would have to pay a fair share in taxes even when they're not selling their stocks or not making taxable moves.
Yeah, and Warren Buffett himself has even said that I don't think he's necessarily a proponent for wealth tax in this format, but he's said on multiple occasions that he thinks that it's absolutely absurd that he pays less taxes than his assistant, even though he's one of the richest people in the world, just because how the tax system is set up.
We certainly shouldn't raise taxes on anybody except the very rich. I think we should raise taxes on the very rich.
So arguments against wealth tax include the difficulty of evaluating many of the assets, especially private businesses, because before a business goes public, it's very difficult to get an objective idea of how much it is worth. And you could argue even if it's traded publicly, it's not very objective, which is what we cover a lot on this channel. But then you still have something that you can base the taxing decision upon. Also, some argue that it would severely diminish economic growth, since a lot of this money tends to be invested. Others, on the other hand, think that if you would instead redistribute the money to people who need it more, they would just spend it and stimulate economic growth in that way instead. So there's a bit of like that could go both ways, some people say. Another problem is the fact that it can be offset quite easily through financial planning, manipulation like leverage, trust funds, and other financial vehicles. Now, if you want to learn more about what you can do to grow your wealth so that you too, hopefully, maybe if you live in Norway, can be taxed on your wealth, please check out this video where I walk you through the fundamentals of investing. And as always, happy investing.
Happy investing, guys. And remember, it's expensive to be wealthy.